Have you been watching the silver market? Something truly historic is happening right now, and it's a story most of the mainstream financial media is completely missing. While everyone's eyes are glued to interest rates and inflation numbers, a massive disconnect is forming in the silver market, and it could signal a major shift in how precious metals are priced globally. So, what's going on? In Shanghai, silver for physical delivery recently hit a record high, trading at around $85 per ounce. Now, compare that to the price on the COMEX in New York, which is hovering around $79. That's a $6 difference, an 8% premium. This isn't just a minor blip you can explain away with shipping costs or currency fluctuations. This is a structural crack appearing between the physical silver market and the paper, or derivative, market. To understand why this is so important, you need to know how these two major markets operate. In Shanghai, on exchanges like the Shanghai Futures Exchange and the Shanghai Gold Exchange, the game is all about physical metal. Industrial users, refiners, and manufacturers are the big players there. They aren't just speculating, they need actual physical silver to make things like solar panels, electronics, and medical equipment. When they buy a contract, they expect to take delivery of real silver bars. Now let's look at the COMEX. It's the primary futures market in the West, but it operates very differently. It's overwhelmingly a financial market. In fact, it's estimated that less than 3% of silver contracts on the COMEX ever result in physical delivery. Most traders are just betting on price movements, rolling their contracts over from month to month or settling them in cash. They have no intention of ever touching a single ounce of silver. This system works fine. As long as there's enough physical silver to satisfy the small percentage of buyers who actually want it, it creates a highly liquid market for speculation and hedging. But what happens when physical demand starts to surge? What happens when industrial buyers get desperate for metal? That's when the paper price set by the COMEX starts to look a little disconnected from reality. And that's precisely what we're seeing today. The huge premium in Shanghai is a clear signal. It tells us that real industrial users are willing to pay significantly more to get their hands on physical silver right now, rather than waiting or relying on the paper market. They are essentially saying, we don't care what the paper price is in New York. We need the metal, and we'll pay what it takes to get it. This implies that the supply of readily available silver is much tighter than the COMEX price would suggest. Think of it like this. Imagine there's one official price for concert tickets online, say $50, but outside the venue, people are desperately paying $200 to scalpers because the show is sold out and they absolutely have to get in. The online price no longer reflects the true demand. Shanghai is the crowd outside the venue, and COMEX is the official, but increasingly irrelevant online price. This divergence isn't just an interesting bit of market trivia, it's a potential game changer. For years, critics have argued that the paper markets, dominated by large financial institutions, have suppressed the price of precious metals. They've pointed out the absurdity of a system where the value of a physical commodity is determined by a market where almost none of that commodity ever changes hands. The action in Shanghai is providing hard evidence for that argument. It shows a market where physical demand is the primary driver, and that market is screaming that silver is undervalued. Industrial demand for silver is exploding. It's a critical component in the green energy transition, especially for solar panels. It's also essential for 5G technology, electric vehicles, and countless other high-tech applications. This isn't speculative demand from investors. It's real, structural demand from industries that are fundamental to our modern economy. As this demand continues to grow, the pressure on the physical supply will only intensify. If industrial buyers increasingly turn to markets like Shanghai that can guarantee physical delivery, what happens to the COMEX? Its role as the global benchmark for silver pricing could be seriously challenged. If the price discovered on a physically settled exchange consistently and significantly outpaces the paper price, participants will start to question which one is the real price of silver. We could be witnessing the beginning of a major repricing event. It might not happen overnight, but the tectonic plates of the global silver market are shifting. The power to set the price could be moving from the financial centers of the West to the industrial powerhouses of the East. This is a market where physical supply and demand are finally starting to matter more than paper contracts and algorithms. So, when you see the spot price of silver on your screen, remember that it's only part of the story. The real action, the development that could have long-term consequences for your investments and for the global economy, is happening in the physical market. The premium in Shanghai isn't just a gap, it's a message. It's telling us that the true value of physical silver is breaking free. Keep an eye on this space. This is a story that is far from over. Thanks for watching. If you found this analysis helpful, make sure to like this video and subscribe to the channel for more deep dives into the markets. Let me know your thoughts in the comments below. See you next time. Have you ever noticed the price of something is different in two different places? Let's say a cool pair of sneakers is cheaper online than in your local store. What do? You buy it online, right? That's arbitrage in a nutshell, buying low in one place and selling high in another. In the world of finance, this is a huge deal, especially for precious metals like silver. Normally, if silver is cheaper in New York than in Shanghai, big-time traders jump in. They'd buy tons of silver in New York, ship it to Shanghai, sell it for a profit, and boom, the price difference disappears. This buying and selling action is what keeps global prices in sync. It's a fundamental mechanism that ensures the market is efficient. But what if that mechanism breaks down? What if you try to buy those cheaper sneakers online, but the website says out of stock? That's exactly what seems to be happening in the silver market right now. And it's creating a fascinating and potentially explosive situation. Let's break down what's going on. We're seeing a significant price gap for silver between the West, specifically New York, and the East, in places like Shanghai. The normal response, as we said, would be for arbitrage traders to step in. They'd buy silver in the lower priced market, which has recently been the West, and sell it in the higher priced East. This should, in theory, cause prices to meet in the middle. The buying pressure in New York would raise its price, and the selling pressure in Shanghai would lower its price until the gap closes. Simple economics. However, there's a critical flaw in this process right now. Arbitrage isn't just about clicking buttons on a screen. It requires moving actual physical metal. And this is where the story gets really interesting. To perform this arbitrage, traders need to get their hands on real, tangible silver bars. They have to take delivery of the metal from Western vaults, like those managed by the LBMA in London or COMEX in New York, and then physically ship them across the world. So, what's the problem? The problem is the sheer lack of available physical silver to make this happen on a large scale. When we look at the inventory data from the major Western exchanges, the numbers are pretty startling. The amount of registered silver, which is the metal that's actually available for delivery to settle a contract, is shockingly low. We're talking about levels below 70 million ounces. Now, 70 million ounces might sound like a lot, but let's put it into perspective. The number of paper claims on that silver, things like futures contracts and other derivatives, is astronomically higher. We're looking at outstanding paper claims of over 900 million ounces. If you do the math, that's a leverage ratio of about 13 to 1. For every 1 ounce of real deliverable silver sitting in these vaults, there are 13 different claims for it on paper. This system, this giant mountain of paper, claims built on a tiny hill of physical metal, only works as long as everyone agrees to play the paper game. It relies on the assumption that most people will never actually ask for the physical silver they have technically bought. They'll just sell their paper contract to someone else before it expires. But the moment a significant number of people start demanding delivery, the whole system comes under immense stress. And that's exactly what the arbitrage trade is forcing to happen. As traders try to buy physical silver in the West to ship to the East, they are, by definition, demanding delivery. They're turning their paper claims into a request for real metal. But with inventories so tight, this process is hitting a wall. There just isn't enough silver to go around to satisfy all the demand that this price gap is creating. Instead of the arbitrage process working as it should and bringing prices together, it's having the opposite effect. The desperate hunt for physical silver in the West is causing prices there to rise, not because of normal supply and demand, but because of the logistical nightmare of actually getting the metal. At the same time, the price in the East continues to be high because the expected flood of cheap Western silver never arrives. So instead of converging, both prices are being pulled upwards. The arbitrage trade, which is supposed to fix price discrepancies, is now exposing the fundamental scarcity of physical silver and actually accelerating the drain on the already low Western stockpiles. It's like pouring gasoline on a fire. Every ounce that gets pulled from London or New York and sent to Shanghai is an ounce that's likely never coming back. This isn't just a temporary shipping delay. It's a fundamental shift in the physical landscape of the silver market. The arbitrage mechanism is broken, and its failure is sending a massive signal to the world that the paper price of silver may be disconnected from the reality of its physical availability. To truly understand the gravity of this situation, we need to zoom out and look at the bigger picture, specifically through the lens of history. Let's talk about the gold to silver ratio. This is simply the price of gold divided by the price of silver. It tells you how many ounces of silver it takes to buy 1 ounce of gold. For centuries, literally thousands of years of recorded history, this ratio has hovered in a very consistent range, typically between 10 to 1 and 15 to 1. This reflected the natural abundance of silver in the Earth's crust compared to gold. Even during the 18th and 19th centuries, when major world governments were on bimetallic standards, meaning their currencies were backed by both gold and silver, they officially set the exchange ratio right around 15 to 1. This was considered the natural, balanced state of things. Now, let's look at today. The gold to silver ratio is currently sitting somewhere between 49 to 1 and 53 to 1. This is a massive, extreme deviation from the historical norm. It's suggesting that silver is incredibly cheap relative to gold, or that gold is incredibly expensive relative to silver, depending on how you look at it. Either way, The relationship is wildly out of balance. History shows us that whenever this ratio gets stretched to such extremes, it doesn't stay there forever. And when it corrects, it doesn't do so gently or gradually. We have a couple of modern examples of this. The first was in 1980. The ratio had become distorted, and it corrected with a vengeance. Silver's price exploded upwards, massively outperforming gold in a very short period, causing the ratio to collapse back towards its historical average. We saw a similar, though less dramatic, event in 2011. Again, the ratio had stretched, and again it was resolved through a sharp, rapid repricing event where silver's value surged relative to gold. What these historical events teach us is that corrections in the gold-to-silver ratio are often violent and unpredictable. They aren't slow, gentle drifts back to the mean. They are sharp, sudden resets that catch most people by surprise. The current situation, with the arbitrage mechanism breaking down due to physical scarcity, feels eerily similar to the setups we saw before these past repricing events. The breakdown in arbitrage is the market screaming that something is wrong. The physical demand is overwhelming the paper supply, and the historical ratio to gold suggests that silver is deeply undervalued. When you combine these two factors, a broken market mechanism and a historical pricing anomaly, you have a recipe for a potentially dramatic and rapid change. We're not just watching numbers on a screen, we're witnessing a potential structural shift in a global market. The failure of arbitrage is the symptom, but the disease is a severe shortage of physical silver in the West at current prices. The historical context of the gold-to-silver ratio provides the roadmap for what could happen when the market finally decides to cure itself. This isn't about predicting the exact day or price, but about understanding the powerful forces at play. The pressure is building, and history tells us that when it's finally released, the move can be breathtakingly fast. Thank you so much for watching. If you found this breakdown insightful, please hit that like button, subscribe to the channel, and ring the bell so you don't miss our next update. We'd love to hear your thoughts in the comments below. Stay curious, and we'll see you in the next video. Did you know there's a metal that's quietly becoming the backbone of our green energy future and modern tech world? No, it's not gold or lithium. It's silver. And right now, we're witnessing a massive surge in demand for it, which could have some huge implications down the road. And let's start with solar energy. In 2024 alone, the solar industry is projected to use around 200 million ounces of silver. To put that in perspective, that's about a quarter of the entire global supply for the year, all going into making sunshine into electricity. What's even more interesting is that the newest, most efficient solar panels actually require significantly more silver than the older models. So as we push for better solar tech, we're also pushing up the demand for silver. Then there are electric vehicles, or EVs. A regular gas-powered car has about 15 to 20 grams of silver inside it. But an EV, it needs anywhere from 30 to 50 grams. Now, here's where it gets really crazy. Scientists are working on the next generation of batteries called solid-state batteries. These could be a total game changer for EVs, but they might need a staggering 500 to 1,000 grams of silver per vehicle. If that technology takes off and EVs become the standard, we could see demand from this sector alone skyrocket into the hundreds of millions of ounces every single year. Of course, it doesn't stop there. Think about all the electronics in your life, your smartphone, your computer, the data centers that power the internet, and the 5G infrastructure that keeps us all connected. All of these rely on silver. Why? Because silver is the best electrical conductor of all metals. It's incredibly reliable and efficient, making it essential for high-performance technology. This creates a fascinating situation. For these industries, the demand for silver is what economists call price inelastic. This means that even if the price of silver goes up, manufacturers can't just stop using it. Switching to a different material would mean sacrificing performance or, in some cases, halting production entirely. They need silver, period. So with all this rising demand, you might think we can just mine more silver, right? Well, it's not that simple. Silver's supply has some serious limitations. First, about 70% of the world's silver isn't mined from dedicated silver mines. It's actually a byproduct. It comes out of the ground when miners are digging for other metals like copper, lead, and zinc. This means that the amount of silver being produced isn't really driven by the price of silver itself, but by the demand for those other metals. So even if silver's price doubles, miners can't just flip a switch and produce more. What about opening new silver mines? That's a great idea, but it's an incredibly slow process. From the moment a new deposit is discovered to the day it actually starts producing silver, you're looking at a timeline of 10 to 15 years. It takes that long to get through all the permits, planning, and construction. Okay, so if we can't easily mine more, can we recycle it? With gold, recycling is a huge source of supply, but with silver, it's a different story. Most of the silver we use is scattered in tiny amounts across billions of electronic devices, solar panels, and other industrial products. It's just not easy or economical to get it back. Right now, the global recycling rate for silver is less than 20%. Even if we magically managed to double that rate, the recycled supply would still fall far short of the growing industrial demand we're seeing. So we have this perfect storm brewing, skyrocketing demand from essential world-changing industries, and a supply that's rigid, slow to respond, and difficult to increase through recycling. This isn't just a story about a precious metal, it's about a critical bottleneck in our transition to a greener, more technologically advanced world. What happens when this unstoppable demand meets an immovable supply? That's a question we'll all be watching closely in the years to come. Thanks for watching. If you found this interesting, don't forget to like this video and subscribe to the channel for more deep dives into the materials that shape our world. See you in the next one. Have you noticed the strange disconnect happening in the silver market right now? There's a massive price gap growing between Shanghai and the COMEX in New York, and it's telling us something crucial about where precious metals are heading. For a long time, the paper-based pricing system, mainly driven by COMEX, has been the global standard. But that authority is starting to crumble as markets that deal with actual physical metal, like the Shanghai Futures Exchange, gain more and more influence. Think about it this way. Shanghai is where a lot of the real physical silver is being bought and sold. COMEX, on the other hand, deals heavily in paper contracts, which are often settled in cash rather than with actual metal. Right now, the price in Shanghai is consistently higher than on COMEX. This isn't just a small temporary difference. It's a persistent premium that arbitrage, the usual market mechanism for correcting these gaps, is failing to fix. Why isn't arbitrage working? Because it's getting incredibly difficult and expensive to buy silver on COMEX, ship it all the way to Shanghai, and sell it for a profit. The costs and logistical hurdles are so high that the price gap remains wide open. This tells us the physical market is much tighter than the paper market suggests. Demand in Asia is booming, pulling physical silver out of Western vaults, and the supply just can't keep up. We've seen this movie before in other commodity markets. Remember the nickel market chaos in 2022? A similar pattern emerged right before a massive price explosion. A growing disconnect between the physical price and the paper price on the London Metal Exchange led to a historic short squeeze. The paper market was forced to reckon with the reality of physical scarcity, and the price went vertical, almost overnight. What we're seeing in silver right now has eerie parallels. The Shanghai premium is the canary in the coal mine. As this premium widens, say towards $8 or even $10 an ounce, it sends a powerful psychological signal to the market. It screams that physical silver is worth more than the paper price indicates. This could trigger a domino effect. More investors will demand physical delivery of their contracts instead of settling for cash. This would drain already low inventories at places like COMEX even faster. Once inventories reach a critical point, COMEX will face a serious problem. It could lead to forced adjustments in its pricing, forcing it to catch up with the physical reality reflected in Shanghai. And here's the key thing to remember. These corrections rarely happen smoothly or gradually. They tend to be abrupt and explosive. The market doesn't slowly reprice, it snaps. So what does this all mean for the average person interested in precious metals? The silver market is showing all the classic signs of a major structural strain. We have soaring physical demand, especially from the industrial and solar sectors, clashing with a constrained supply from mines. The traditional bridges between paper and physical markets are breaking down. While it's impossible to predict the exact timing of a major repricing event, the underlying pressures are undeniable and building every day. The price in Shanghai is becoming the true benchmark for real-world supply and demand, while the COMEX price looks more and more detached from physical reality. How this massive disconnect resolves will be one of the most important stories in the precious metal space for years to come. The tension is palpable, and something has to give. Keep a close eye on that Shanghai premium. It's more than just a number on a screen. It's a direct indicator of the stress in the global physical silver market. The shift from west to east in the precious metals world is happening right before our eyes. Thanks for watching. And if you found this breakdown helpful, be sure to like and subscribe for more insights into the markets.